All right, everyone, thanks for coming in today. It's good to see a lot of familiar faces. It's been a busy 6 months. We've got a lot to talk about, so I'm just going to dive right in. I'm going to give you guys some brief highlights summarizing some of the progress that we've made over the last 6 months. Brad's going to dig into the financial results, and then I'm going to go a little level deeper on our operational progress and the progress on the strategic priorities that we mentioned at the beginning of the year. If I had to summarize kind of where we're at in 2 words, it's on track. I feel really good about the progress that we've made over the last 6 months and the indicators that are demonstrating that our strategy is working. So everything that we kind of brought up at the beginning of the year, we've essentially put in place, and it's starting to work through. So we built out a central sales and marketing function, which is the first time that we've had that at the business. That's resulted in some new wins, a new channel for growth that we didn't have before. Our sector focus is paying off. We put an emphasis on healthcare in these last 6 months because we wanted to prove that we could take a strong competency that we had in our strategy pillar and see that flow through into our activation pillars of innovation and communication. And we saw that bridge get built, and we'll talk a little bit more about that. We expanded into the U.S., so we brought our communications function into the U.S. for the first time and have started selling into our Fortune 500 client base there. And we also expanded our strategy capability in New York. And our partnerships with Google and Pivotal, which are very strategic, continue to scale. So these are vendors that sell software into the same clients that we do, that we build experiences on top of. And those partnerships are continuing to grow and offering another channel of growth for us. So on the whole, I'm really encouraged by all the progress we made in a relatively short amount of time and getting a lot of those seeds planted. In the meantime, the digital transformation market, you'll hear us abbreviate that as DX, because digital transformation is a bit of a mouthful. It's continuing to grow faster. And we're encouraged by our by the growth in the market and its perceived staying power. We've made some really good progress realigning Kin and Carta's various specialisms for that opportunity. On the whole, revenue was in line with the prior year. Our innovation pillar, which is, and we'll talk a little bit more, kind of recapping how we've structured the business, but our innovation pillar, which is really the core of our digital transformation offering, are seeing the fruits of this positioning, and it's grown 18% on a like-for-like basis. The strategy and communications pillars, we've had to pivot a little bit to make sure that they are aligned with that DX focus. So we've merged brands, we've reorganized some management, we've got a lot of that work done, we've got a little bit left to do. That's caused us to consciously shed a little bit of revenue that we would consider to be non-strategic or lower margin in the short term, in favor of focusing on higher margin, more strategic work aligned with our DX focus for the longer term. So got more to do, but I'm really pleased with how well we're moving. And we'll dig into some of those details in a few moments. For now, I'll turn it over to Brad, and he will go through the numbers.
Great. So as Jay said, we put in place the strategic initiatives to deliver on the company's future growth. And just to go through some quick highlights, like for like, our numbers are broadly in line with the prior year. We've had strong growth within innovation, so 18% in line with market growth. As Jay said, we've exited some lower margin work within Strat and Comms, and we've seen a slight reduction in revenue in those two pillars. But we've actually maintained the operating margin. Our debt level is 33 million, which is 1.44 times, slightly higher than the year end. We've paid some deferred consideration, but we've also realised the sale of a warehouse from one of our legacy businesses at £7.2 million. And we've maintained the dividend at 0.65 pence per share. So what's just a very brief overview of the group, and what this demonstrates on these two charts here is really our direction of travel going forward. So you'll see the shift in capabilities. Innovation is now 46% of group revenue. It was 40% at the year end. So more focus on innovation. And also, to reiterate, the lines between our three pillars there are blurred. So we have strategy capabilities within innovation, as well as purely in strategy. And also, our direction of travel is more focused to the US. So the US is almost 40% of the revenue. Now it was 36%. So looking at the income statement, as I said, numbers are broadly in line with the prior year on a like-for-like basis. There's a significant reduction in one-off items, so just under £10 million compared to £28 million in the prior period. And I'll go through some of those items on a subsequent slide. In terms of year-end revenue guidance, we guided in October to roughly 5%, so mid-single digits. We've marginally brought that down, and we're guiding to circa 3.5% for the full year. That's been offset by higher margin, and we anticipate in maintaining that higher margin throughout the rest of this year. We continue to spend on the strategic initiatives. So we highlighted at the year end that we're going to spend £2 million, and we're on track to do that for the full year. There's also a couple of new IFRSs coming out. So we've got IFRS 9 and 15. We don't anticipate any impact on those. We've made an assessment, so no changes as a result of IFRS 9 or 15. IFRS 16, which is on leases, is coming into effect, and that will impact our 2020 results. So just looking at the adjusting items, significant reduction in adjusting items. In prior periods, because of the acquisitions that we'd made, we had a significant charge for contingent consideration. This time round, it's £1.6 million against 18.5. We've still got a bit to come, so there'll be a charge of just under £1 million in H2. Amortisation of acquired intangibles will continue, so that's acquisition related, effectively what was old goodwill. Pension costs, so we put through a charge for an equalisation of guaranteed minimum pension, which is £3.9 million. So that's the result of a High Court case back in October with Lloyds Bank, and it basically equalises pension arrangements between males and females. That's an estimate at the moment, so there's further work to do on that. And we've had some restructuring costs and the sale of the property. So the sale of property, we made £2 million, and there's £1.2 million worth of restructuring costs against that. Just looking at the balance sheet, just remind everybody within fixed assets, we've still got an investment property which relates to our sold books business. That sits at £5.2 million. We get a rental income off that. Redditch was sold in the period. We've lost the rental income off that, which is roughly £400,000 per annum. Debt at £33 million, 1.4 times. We're looking at debt at the year end of circa £34 million, which is roughly 1.5 times net debt to EBITDA. The pension scheme has gone into deficit. That's partly as a result of the additional GMP liabilities, which are just under £4 million. But also the asset performance was off towards the end of the year with a decline in stock markets. Just remind everybody that we've got the triennial valuation coming up in April 19. But as we stand here today, I'm not expecting the cash contributions to increase, which are £3 million. just looking at the cash flow. So we've had a working capital outflow of £3.5 million. I don't expect that to reverse, but I don't expect it to increase. That outflow has been offset by a lower tax payment in the period. So we had some benefits of some of the things that we did last year, i.e. we made a contribution to the pension scheme. We've got some tax relief on that, and I'm not expecting any further tax payments in H2. So effectively, there are no corporation tax payments in FY19. And then we've got the normal pension payments, which is £3 million a year, so £1.5 million contribution in the first half, plus some other pension costs around the PPF levy coming through. And I will hand back to Joe.
Thanks, Ben. Thanks. So I want to take just a moment to remind everybody what we do. So we are a digital transformation consultancy. We help companies reinvent themselves for the digital age. And we really break down that offering into 3 different pillars, which I'm going to touch on in more detail as we go forward here. Strategy is really about helping companies define where they should play and how they should win in the new digital age. So what are the offerings that they're actually selling to their customers? How should they modify their current products to either digitally enable them or build new digitally driven services to augment their existing business models? That's really the strategy pillar. So it's kind of the strategic front end to our overarching proposition. The innovation pillar is where we actually build products and services for these companies. This is the core of our offering, where a bulk of our work comes from. Out of our 1,500 employees, over 600 of those are engineers. So we're actually doing heavy lifting as it relates to building products and bringing them to market. And then the communication pillar is really about, it's our digital marketing function that's about helping companies lay down these new marketing technology platforms that allow them to communicate to their customers in modern ways and ultimately help them attract and retain customers for these new products and services that we're helping them build. So on their own, each of these offerings is really valuable, but when you put them all together, it's even more valuable because it allows companies to move much more quickly from strategy to action to outcomes. And the name of the game these days isn't scale, it's speed. So the holistic proposition is very important and it's resonating. And so as you would expect, every company to some degree is going through this journey right now. So the market is large and it's growing, and some recent statistics came out from IDG, a report last month, that predicts by 2020, 30% of the global 2,000 companies, so the 2,000 largest companies in the world, will allocate capital budgets of at least 10% of their revenue to digital transformation initiatives. So this is a big market. It will continue to grow. It's very strategic to the customers that we work with. So operationally, just to kind of give you a little peek under the covers of what we've been up to, I mentioned, so our strategy pillar at the top has business transformation, so core, kind of think of it as core management consulting, business transformation consulting, market research, and digital experience strategy capabilities. When you combine those 3, it is absolutely a differentiated strategic front end in the market. And so our past 6 months have been spent building closer alignment between those strategic capabilities and these activation segments. Before we started this strategy, before we embarked kind of on our new strategy, that pillar was essentially on an island. So they were doing strategies that would then be deployed by some other firm potentially, or sit on a shelf. So we have built that bridge between strategy and communication and innovation, which was quite a bit of work to do, and now that's in market and we're seeing the fruits of that labor. So that change in focus for our strategy folks has had some impact on near-term revenue, but it's deliberate. We believe having a single front end to that to our Kin and Carta proposition will ultimately increase higher quality revenue at a higher margin in the long term. So we're very happy with the progress there. We don't anticipate significant continued revenue decline in that pillar. The innovation segment is, as I mentioned, and as Brad mentioned, is the core of the Kin and Carta DX proposition, representing 46% of our revenue. Our capabilities in that space were where we wanted them to be when we started, and so our focus really over the last 6 months has been scaling. So building the bridges between innovation, communication strategy, and just scaling that market-leading capability. And that is scaling both in the US and in the UK. And it's good to see, particularly in the UK. So even in this era of kind of uncertainty, companies are still investing heavily to build these new products and services as they need to in order to remain relevant for the future. So we'll continue to expand our innovation specialism through new capabilities, new regions, and new sectors, and we'll talk a little bit more about that. And the communications piece on the bottom right it is our design and build, our digital comms, and our data science capabilities. And those are essential to actually driving the outcomes from those other two pillars. So if we build something that's great, we need to make sure our clients can sell it. And that's where comms comes into play. Digital marketing is a very competitive segment of the DX market. And before we actually launched in the US, so we launched an office in Chicago for the first time in November. Before that, all of our communications revenue was coming from the UK. So we did see a little bit of drag from GDPR impacts and Brexit uncertainty in that pillar. But despite that, we've won 9 different industry awards in the last 6 months and seen some significant new client wins, including Shell, which is one of our fastest growing accounts in the comm sector to date. We have this team really focused, as I mentioned before, on platforms. So getting away from what I would consider to be flighty kind of campaign-based work that can kind of come in and go out, meaning the work that we would do on a campaign might last months. The work that we do building a platform for a company would last years. So we are really focusing the comms specialisms on platform work, which is more aligned to DX. And that pivot has had some impact on near-term revenue as well. But again, that has been intentional. So on the whole, I am pleased with the progress that we're making across all 3 of these pillars. The engagement from the employee base across the board has been extremely high. The collaboration has been fantastic. And I'd like to illustrate that for a second. And bear with me because this is kind of a geeky slide, but I think it's important. So you guys have heard us talk about the connective. The connective is our organizational structure that joins up all these specialisms to deliver a holistic proposition to the client. It's how we organize ourselves to be able to bring it all together, to bring it to kind of achieve those holistic outcomes for our customers. And a lot of our big consulting and agency groups, competitors, will talk about how they're collaborating across their different divisions. But a lot of times when you look under the surface, it's really more talk than it is action. And what this is meant to demonstrate is that it's very real for us. So this is a couple of our engineers geeked out and created a data visualization of the communication happening across the connective, so across our different specialisms, just in the month of February alone. We've had over 1.1 million messages sent between different specialisms across 2,600 different topics. And what that's resulted in, or it's been a key driver of 15 new deals in the first half, which we're calling connective deals. A connective deal for us is when multiple specialisms come together to actually sell work to a client. So that's work that we wouldn't have seen a year ago before we started this strategy. And that's inked more than $8 million in additional revenue. So just in the last 6 months, to see 15 deals sold and $8 million of revenue is a really positive sign for us. And this is one of the key indicators that we'll be tracking going forward. So when we talk about the name of the game being speed, this is what it looks like for us. And then I'm going to go through some of our strategic priorities, and we'll open it up for questions. So I, at the beginning of the year, spoke to you about 6 what we called growth catalysts. So these are 6 different engines of growth that we wanted to create, or at least plant the seeds on, that ultimately would drive to that double-digit top-line growth that we're expecting to see next year. The first piece of that is actually the rollout of the connectives. So we talked about that. That's our holistic DX proposition, and we're seeing some significant new client wins and a big pipeline getting built up there. The scaling of our sales function has been key. It's been a big focus for us, and we've completed standing up that team, or teams, I should say. So that includes central marketing, that includes outbound lead generation, and a new central direct sales teams, while we're also moving all of our specialisms onto one common CRM and ERP system, which is going to help us with better reporting going forward. So a lot of really good work there in getting the right people into the right roles and the systems needed to make them successful. So we're excited to see that. Deepening our sector focus, we just spoke about. The healthcare sector was a focus for us over the last 6 months to prove we can build those bridges, and we've seen that work come through in sizable 7-figure deals that could grow to 8 figures in time. So very happy about that progress. Another seed that we planted is bringing communications into the U.S. and expanding our strategy capability in the U.S. So in both Chicago and in New York, we've got the teams stood up there. They're selling into our existing client base. We've gotten some early wins there, and they are ahead of plan. So that is encouraging to see. And then new capabilities and partnerships. The opportunity that we have being in this space is the technology continues to evolve. It's not like digital's done being developed. Every year there's new platforms, new technologies coming out of Google, Apple, Facebook, Amazon that are driving this market. And we are partners with many of those companies. And 2 of our key partnerships are with Google and with Pivotal. And just to give you a sense of why that's important. So Google, you guys are probably familiar with Amazon Web Services, which is a massive infrastructure business that Amazon has been selling to the enterprise, and that really is funding their retail business. Google has up until recently not gone after the enterprise market. Well, late last year, they hired in a guy named Thomas Kurian, who used to be from Oracle, and he became the CEO of Google Cloud. And Google has made a decision to go after the Amazon market, the Amazon Web Services market, because many businesses are starting to question whether they should be investing in Amazon's cloud, since Amazon is the potential to be their competitor, whether from a retail perspective or a lot of these other segments that they're getting into. So Google has seen a great opportunity there. We have excellent Google Cloud case studies with Gordon Food Services and Discover, which are 2 of our strategic clients. That's created a lot of credibility for us. And so Google now has created what they call a 100% partner attach goal, meaning they want a consulting partner involved in every single one of their deals. And they're looking at us as their key partner in the Midwest and the East Coast in the U.S. So we already have sold a project with them with Kroger, which is one of the largest grocers in the country and the U.S., and we're expecting our Google work to continue to scale as they implement this new enterprise-focused strategy. So very exciting opportunity for us there. Pivotal is another one of our key partners, and Pivotal is another cloud partner that allows companies to build software on the cloud that's portable. So they could build it and run it in Amazon, or move it to Google, or move it to Microsoft Azure, so they can build it once and run it across clouds. That's really attractive to these big businesses that we work for, because it gives them the flexibility to move as these different businesses' strategy changes. It also allows them to run things on premise, which is what our banking clients like. So they can run it in the cloud or in their own data center. So they have been a key partner of ours And their sales reps now earn double commission if they have a partner identified at the time of a software sale. And we have been named their premier agile development partner at their conference last year, and we've got a ton of a pipeline building with Pivotal. So partnerships are really important to us because they drive new channels of growth and new areas for us to evolve the business into, and those are two of our key partners that we'll be investing in going forward. And then finally, from an acquisition standpoint, acquisitions remain a part of our strategy. We are identifying digital transformation businesses to add to our existing capabilities, but also to help us grow regionally. So we are looking to build delivery centers in the same places that our Fortune 500 clients in the US have delivery centers. So we have one in Chicago, we have one in New York, we want to build one in the South, and we want to build one in the West. So we are focused on those two regions because we believe we can buy a small to mid-sized company that's in our space and scale them quickly on the back of our integrated connective proposition. So we are evaluating some options there, and although I don't expect one of those deals to come through in this year, it is absolutely part of the plan for FY20. So on the whole, I'm really pleased with our progress across all 6 of these catalysts. Each one of them will provide a different element of our growth going forward. So in summary, good progress operationally and across these strategic functions. The build out of the sales and marketing function is complete. The connective proposition is defined and in market. We're expecting this to continue to gain momentum. We are seeing real tangible benefits from our focus on innovation. We've definitely made a name for ourselves in the market and being recognized for bringing quality work to these customers with that focus. And we are on track to meet the board's PBT expectations for this year and teed up for the double-digit growth we're expecting to push through next year.